Hello and welcome to today's session. All lines are in listen-only mode. This event is being recorded and will be made available after the call. If you have any technical issues during today's program, please use the raised hand icon and a member of the production team will reach out to assist you. Our panel today includes Mike Reynolds, Vice President, Credit Risk Transfer, Christian Valencia, Vice President, CRT Capital Markets, and Jeff Shue, Director, CRT Reinsurance. I will now turn it over to your host, Mike Reynolds. Mike?
Thank you, Peggy, and good afternoon, everyone. And we appreciate you taking the time today. Hope you had a good holiday, were able to have a good New Year, took a little time off. Hope COVID is not negatively impacting you and your family and your friends too much. We know it's all impacting us. We did want to take some time and just give you an update of what we're seeing this year and a look forward on 2022. I do need to caveat that today's presentation includes forward-looking statements. These forward-looking statements are subject to change. Any types of factors could influence the ultimate outcome of what we end up doing this year. But we did want to give you a sense of some changes that we see and give you some time to start to prepare for those. So 3 main themes that we're going to cover today. I think it's going to go fairly quickly. And we're not going to take any questions on today's call, but we are certainly happy to answer questions individually. So please reach out to me, Christian, or Jeff, or anybody on the CRT team, and we can definitely schedule follow-ups with anybody who's interested. So the first theme is, as we're operating our CRT function in 2022, we're looking at our capital requirements as defined by ERCF. And for the exact same collateral under ERCF, which is our new regulatory capital regime, the required capital is higher than our previous capital regime, which we call CCF. So that on its own is driving us to obtain more credit risk coverage, credit risk transfer coverage via the form of a higher detachment. So that's number one. That higher detachment is going to result in a significant increase in investment grade opportunities. So we want to highlight that for you. And then thirdly, with this higher detachment, we think it makes sense to tweak the structure a little bit to give investors in reinsurance markets opportunities to be able to participate in the capital stack where they best see fit. So if we move to the next slide, here's a very generic example. So these are recent transactions from the end of 2021, running from HQA3 through a couple low LTV transactions in HQA4. And what you see in the gray bars is the regulatory requirement under the CCF regulatory regime compared to the dark bars, which is under the ERCF. So when you look at the left-hand side, HQA3, you see that for that collateral pool, CCF required about 400 basis points, ERCF required 600 basis points. So same collateral, different regulatory regime, 200 basis points more capital required to be held by Freddie Mac. And you see that theme throughout all of the transactions. If we look at, say, the third transaction there, 2021 DNA 7, under CCF, the gray bar, you had approximately 300 basis points of required capital. Under ERCF, you're in the mid 500s, so an increase of about 240 basis points. So these are all look-back transactions. None of this is indicative of a specific transaction that we'll be selling this year. But I do think that gives you, it's intended to give you a sense of Freddie Mac is now subject to higher capital requirements. Those higher capital requirements are driving us to have higher levels of CRT coverage on the same collateral. If we move to the next slide. So here's, again, this is an illustrative example. This is not a sale of a specific transaction. Actual transactions, study very closely the prospectus and deal documents. But what we're doing, because we're having this higher detachment, we're going to be offering, instead of just the straight up M1, we're going to have the opportunity to split that M1 into an M1A and an M1B. Now, investors can still, buy both the M1 and the M1B, and you'll be back together at the same M1. Reinsurers will be able to do that. There'll be some amount of flexibility between the two individual offerings, but this is our expectations of what you'll be seeing when we do offer actual transactions. So if you look at the left-hand side, the M2, B1, B2 classes, they remain the same, but we're going to take that M1 and you go over to the right-hand side, we're going to break that M1 into an M1A and an M1B. Still sequential. Same sequential all the way from the top of the stack to the bottom. So M1A has to be paid off completely prior to M1B starting to cash flow. Losses are still applied from the bottom up, so no changes from that perspective. This will be very, very high grade IG. So for now, I think we'll just call it, M1A and M1B will both be investment grade. I think, again, dependent upon deal by deal, I think it's very likely the M1A is going to get an A rating or an A minus type rating for probably most transactions. So to the extent that opens up any incremental pockets of money for the funds that you're managing, that's something to keep in mind, that's our intention. We will be rating these transactions, these tranches on an individual basis. We do expect the M1A to definitely have a better rating, obviously given its position in the capital stack. Relative to where we were for M1s finishing up 21. If you look at the table below and focus in on the wall columns and comparisons of the wall columns, so what we're seeing is for our M1 transaction that has just under on the 2021 side, a wall of 1.77, so just under 2 years. Now look at what we have in M1A. So M1A is very similar to that. Investment grade, higher investment grade, most likely. Walls around the same. It's it's around 2.2, so it's a little bit longer. The M1B now becomes a longer duration investment grade bond, and this is kind of and I'm using capital markets terminology when I describe it as a bond there. This becomes a longer duration investment class. So now you can see that 4.8 in this illustrative example. The other thing that we wanted to highlight, although there's no changes to the M2 directly, the fact that we are increasing the detachment, the M1's becoming larger relative to the ratio of the overall capital stack that we're selling, the duration of the M2 is lengthening out. So on the left-hand side, you see a wall of 3.9, 3.87, around that to 3.9. And on the right-hand side, it's a little bit longer of a duration of 5. So this is what we wanted to highlight to you, both from a dollar perspective, this increase, which I'll cover in a second, volumes, as well as where in the capital stack that's playing as in the durations. If we move to the next slide, I'll talk volumes estimates. So we're estimating that we're going to have a net increase in new issuance this year. So we're looking at 25 billion of issuance this year, up from approximately just under 19 billion last year. And this is across both programs, the STACR program as well as the ACIS program. We will continue to split our business between those two programs. We do expect at least half of this 25 billion to be investment grade or better. And so if you look on the right-hand side, we've broken out that the Bs, the B1s, B2s are probably actually going to be a little bit lower in volume. M2 is roughly the same, and the growth is really going to come in that M1 tranche, the top of the M1 tranche. Now this is, we do want to point out, this is an estimate, absolutely subject to changes, market conditions, and this also does not factor in pay downs, buybacks, calls. So you'll be on your own to make your own net estimates, but this is in terms of gross new issuance. Here's our expectations on a look forward basis. With that, I'm going to turn it over to Christian, who will talk a little bit about the STACR calendar.
Thank you, Mike. And again, thanks everyone for joining this call. As Mike said, we do expect to have a very busy year on the STACR side as well. As you can see here, we have a full calendar, at least 10 transactions as you see here in the calendar, and we're going to start both Q1 and Q2 with 3 transactions in each quarter. And we will be covering Q3 2021 securitizations through Q2 2022 securitizations. That's our plan right now. And starting the year, to be able, given the big size of fundings that we had in 2021, we're going to split the low LTV collateral into 2 deals, both in Q1 and Q2 of 2022. You have some numbers here with the reference pools. We're trying to provide that additional information just to be more transparent with you, and you can start to plan ahead what the potential deal sizes would be given that reference pool. We provide a range given there's still some prepays, drops from loans that maybe don't make it into the reference pool, but this provides a good base for you to be able to determine that. And that will be done for both, throughout the year. We'll continue to update this calendar. So we should be checking these regularly as we get more information. We'll continue to update that reference pool sizes over time. It's important also to note that, the second half of the year, you can see here, we've only put 2, 1 DNA, 1 HQA. That could change depending on the final reference pool sizes. We could split that into 2 deals, either on the low LTV or the high LTV as needed. But I just want to make sure that this is, Mike said, forward looking. So that's what I'm saying, at least 10 transactions here. And in addition to that, as you were aware, last year we did the buybacks. We don't have yet anything that's been finalized, but we potentially could be looking at that for 2022 as well, and would allow to be able to use some of those monies to invest back into where we see most of the growth in the IG space on the M1A and M1B, where that's going to be the big part of the growth. And one thing that we do note is on down in credit on the B2s, we do expect that the issuance would be very similar to what we did in 2021 from a STACR perspective. We understand that that's money that that you as investors would be looking to raise because most of the pay downs or buybacks would not really be coming from those bonds. But just want to make sure that you guys are aware of what the potential issuance is there. This year was just over or just under 5 billion. Again, probably slightly lower than that, but in that same ballpark as we finalize our numbers. So with that, I'm going to pass it on to Jeff Shue, who would be talking about the reinsurance market calendar.
Thank you, Christian, and hello again to the reinsurers that have joined today. If you're on the Jan 1 cycle, I hope you had a successful renewal season. It's great to have everybody back together 2 months in a row. I'd like to keep up a good frequency of communication throughout 2022. It's nice also to be able to talk about a calendar and to do that early in the year and have some more certainty this year about the issuance patterns. As you saw from us last year, once again, we talked last month about what a successful year it was. Very large, 8.2 billion in purchases through the ACIS program. We expect it's another significant year, and to all the points that Mike made, our structure, the way that we interact with you as a market, we expect to remain largely the same, but we are interested in purchasing more on the top of the structure. And so that's consistent for the ACIS program as well. And we're going to come to market 11 times this year. It's what we have here in the calendar. And we've changed the series name as we indicated that we would. So we're using the SPL and SPH series names. It's really the same product as the SAP, the SAP deals, but we're being very clear as to what is a low LTV versus a high LTV reference pool. So SPL1 and SPH1 are the first deals out of the gate. What we've done, as STACR is doing, is we're splitting the first low LTV transaction. The reference pool is large, splitting that into a couple transactions. By the end of next week, you'll have materials from us on SPL1 and SPH1. We're running them in parallel. And so we're moving quickly on those first transactions of the year, but 5 planned transactions in the first quarter, 2 in subsequent quarters. And in terms of the upper layer, the M1, the M1A and M1B concept, you will see some testing from us related to that construct, which is sequential pay, as Mike indicated. So underwriters that are considering what this might mean for your process, it's adding a sequential tranche to the typical 4 tranche structure on the top. So you will see that from us with SPL1, SPH1. We also are likely to execute some forward style transactions. And what you've seen from us in the past, we've labeled those forwards, the AFRM, the Affirm product. Here, we would anticipate doing some short, perhaps 1-month fill-up forward transactions through the course of the year. So a mix of spot transactions where we're looking back at a known pool, and a mix of short, perhaps 1-month fill-up transactions that we'll use to execute throughout the year. So SPL1 and SPH1 will be standard spot transactions. SPL1 focuses on low LTV from September of 2021. SPH1 focuses on high LTV from December of 2021. And that's consistent with the approach we had in 2021, where ACIS is handling the risk transfer objectives of a specific month of a given quarter. So that's at least the plan as laid out here. As you know, last year we executed several call options. We thought it would be helpful to list the 9 transactions that are up for call in 2022. We know that has an impact on total aggregate capacity. In addition to the runoff, the paydowns that we expect to occur through the year, very significant paydowns, we are reducing outstanding limit using the call option. So of the 3 opportunities that we have had to call transactions to date, we have executed those. And we also wanted you to be aware of the upcoming eligible call options and listed them by quarter for you here. So again, if you have any questions on the issuance calendar, please reach out. Happy to answer any questions you have. And with that, I'm going to turn it back to Mike Reynolds.
Thank you, Jeff. So that's really all that we have for today's call. Its intention was to give you a heads up on what we are projecting seeing for 2022, the higher detachments, largely driven by the new regulatory capital regime, the ERCF. We're going to split the M1 into an M1A and M1B. That's going to create some incremental investment opportunities for you. This deck will be posted on our crt.freddiemac.com website, so it's available to you. As Jeff and Christian and myself had mentioned, please reach out to us, call, email, IM. We're happy to do follow-up conversations. We do have a quarterly webcast later on this month. We've been doing this pretty regularly. Our next one is on January 20th. So please register for that, and we'll do a deep dive on analytics and performance. And to the extent that we have any updates, we'll do that as well. And then again, please just note that these are all forward-looking statements, subject to change. And but we still are, we're thanking you for your time, and hopefully you'll find this helpful for your business. Thank you.